Imagine accounting as a majestic and ancient tree, my friend. It has grown and flourished over the ages, sprouting numerous branches that contribute to its complexity. Among these branches, we find financial accounting, managerial accounting, tax accounting, audit accounting, and bookkeeping. However, when most folks mention accounting, they usually refer to financial accounting. Now, let me shed some light on what financial accounting actually entails. Unlock the secret to financial success with Kountin Koins, where numbers come alive and your accounting game thrives. Hey there, and welcome back to our channel. We're here to help you unravel the fascinating world of financial accounting. If the definition of financial accounting sounds a bit perplexing, fear not. Spend the next 10 minutes with me, and I'll guide you through the ins and outs of how it all works. It's essential to stick around until the end to grasp the bigger picture. Ready? Let's dive in. When it comes to financial accounting, the first step is to identify the transactions. In this case, the transaction we're looking at is the $40,000 in new annual subscriptions for the Daily Gazette, starting on April 1st and ending on March 31st next year. Now that we've identified the transaction, let's move on to the next step. Step 2 involves preparing a journal entry, which is a record of the financial transaction. The journal entry for this transaction would look something like this: journal number, date, description, accounts affected, cash and subscription revenue, debits, $40,000, credits, $40,000. In this case, since the Daily Gazette shows double entry accounting, the transaction affects at least two accounts, which are cash and subscription revenue. The debits and credits both amount to $40,000, ensuring that the equation remains balanced. Now you might be wondering, why do we use double entry accounting? Well, it's a system that helps ensure accuracy and reliability in financial records. By recording both the debits and credits for each transaction, we can maintain a clear and balanced picture of the company's financial activities. This allows us to easily spot errors, track the flow of money, and prepare accurate financial statements for analysis and decision-making. Double entry accounting is widely used because it provides a solid foundation for maintaining the financial health of a business. Double entry accounting is a fundamental concept that ensures your business's financial records remain accurate and balanced. It's based on the idea that what your business owns, assets, is equal to what it owes, liabilities, plus what is owed to you as the owner, equity. This relationship is represented by accounting equation. Assets equals liabilities plus equity. Assets are valuable resources that your business owns, such as cash and inventory. Liabilities represent what your business owes to third-party lenders or suppliers, while equity represents your claim on the business's net assets. The accounting equation revolutionized the way transactions are recorded. Every transaction has at least two equal and opposite sides. To maintain balance, we use debits and credits. Debits reflect the destinations where economic benefit flows, while credits represent the sources from which it flows. Double entry accounting is widely used by large businesses, including the Daily Gazette. In the case of $40,000 in new annual subscriptions, you would debit cash by $40,000 to increase your assets and credit subscription revenue by $40,000 to record your income. Moving on to step 3, we need to post the journal entry to the general ledger. The general ledger is a comprehensive record of all your financial data. In the past, it used to be a physical book, but nowadays, accounting software treats it as a central database. To post the journal to the general ledger, you record the transaction in specific accounts. There are 6 main types of accounts: assets, liabilities, equity, revenue, expenses, and dividends. Each account is used to record and categorize transactions that affect a related group of items. By posting the journal entry to the general ledger and updating the relevant accounts, you ensure that your financial records are organized and accurate, providing a solid foundation for financial analysis and decision-making. To visualize the impact of the journal entry, we can use T accounts. Imagine the two T's labeled cash and subscription revenue. Debits go on the left side while credits go on the right side. When posting the journal entry, you debit $40,000 on the left side of the cash account and credit $40,000 on the right side of the subscription revenue account. Adding up these amounts, your cash balance increases to $48,000 and your subscription revenue totals $75,000. The Daily Gazette has other accounts as well, including a range of assets, liabilities, equity, revenue, and expense accounts stored in the general ledger. This journal entry is posted in March when the cash is collected. Now let's fast forward to the end of the financial year, December 31st. Step 4 involves preparing an unadjusted trial balance. A trial balance is an internal report that summarizes the closing balances of all your general ledger accounts. It serves to check for errors and, more importantly, helps in the preparation of financial statements. To create a trial balance, you simply list all your accounts and their closing balances. The closing balance represents the cumulative total of all transactions affecting an account. Debits are listed on the left side and credits on the right side. At the bottom of the trial balance, you calculate the total debits and total credits. These amounts should match exactly because the accounting equation always holds true. The term trial balance comes from the idea of testing or verifying if the debits and credits in your accounting records are in balance. It serves as a trial or test before moving on to prepare financial statements. It's called an unadjusted trial balance because it hasn't been adjusted yet. However, since you've reached the end of the financial year, it's time to move on to the next step. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Step 5 involves posting adjusting entries. Adjusting entries are journal entries made to bring your books in line with the accrual method of accounting. The accrual method of accounting is an important concept that aligns with accounting rulebooks such as the International Financial Reporting Standards or generally accepted accounting principles. These rulebooks ensure that financial statements provide a true and fair view of a business, which is crucial for lenders and investors. Both IFRS or GAAP emphasize the accrual method of accounting, which means recognizing revenue as it is earned and recording expenses as they are incurred. This method provides a more accurate calculation of profit. However, the Daily Gazette has been using cash accounting, where revenue is recognized when cash is received and expenses are recorded when cash is paid out. This approach does not align with the accrual method. Let's take a closer look. In March, the Daily Gazette collected $40,000 in cash for annual subscriptions starting on April 1st. You recorded the full amount as revenue on March 31st. However, in accrual accounting, revenue should be recognized as it is earned, not when cash is received. In reality, you will earn that $40,000 in revenue over the next 12 months as you release each issue of the Daily Gazette. As of December 31st, you have recognized 12 months of income in this financial year. However, you haven't yet earned revenue for the remaining 3 months, which will occur by the end of March next year. Adjusting entries will help rectify this discrepancy. Adjusting entries ensure that revenue is matched with the period in which it is earned, and expenses are recognized in the appropriate accounting period. These entries bring your books in line with the accrual method of accounting, providing a more accurate representation of your financials. To rectify the situation and align with the accrual method of accounting, we can post journal entries to reverse 3 out of the 12 months of your subscription revenue, which amounts to $10,000. This $10,000 will be temporarily held as a liability in an account called deferred revenue or unearned revenue. It's classified as a liability because you still have an obligation to provide customers with the Daily Gazette from January to March. By posting this entry to the general ledger, we can proceed to generate a new adjusted trial balance. Step 6 involves creating an adjusted trial balance, which reflects the impact of the adjusting entries. In the adjusted trial balance, you will notice that your subscription revenue has decreased by $10,000 while your liabilities have increased by the same amount. Despite these changes, the debit and credit totals still match, maintaining the balance in the journal entries. Congratulations on following the accrual method of accounting. Now that the adjusted trial balance is complete, we can move on to step 7, which involves creating financial statements. Financial statements are accounting reports that summarize your business's activities over a specific period of time. These reports provide valuable information to investors, lenders, and creditors, allowing them to assess your business's financial health. The 3 main types of financial statements are: 1. Balance sheet. This statement provides a snapshot of the business's assets, liabilities, and equity at a specific point in time. It shows what your business owns and owes, providing insights into your financial position at the end of the financial year. 2. Income statement, also known as the profit and loss statement. The income statement summarizes your business's revenues, expenses, gains, and losses over a particular period. It showcases your business's profitability by calculating the net income or net loss. 3. Cash flow statement. This statement tracks the inflows and outflows of cash in your business during a specific period. It shows how cash is generated from operations, investments, and financing activities, providing insights into your business's cash position and liquidity. Using the adjusted trial balance, we can generate these financial statements, which serve as essential tools for analyzing and understanding your business's financial performance. The income statement summarizes your business's revenues and expenses over a specific period, providing insights into your financial performance and profitability. In the case of the Daily Gazette, it would cover the previous year and reflect the accrual method of accounting. It's important to note that the income statement focuses on profit, which may differ from cash flow when using the accrual method. The cash flow statement, on the other hand, tracks your cash inflows and outflows during the same period. It provides a separate analysis of your business's cash flow activities, showcasing how cash is generated and used. Financial statements, including the balance sheet, income statement, and cash flow statement, are used by investors, lenders, and creditors. Investors assess your business's performance and make decisions regarding buying or selling shares. Financial ratios, which we haven't covered in this discussion, can be used to analyze the statements and gain further insights. After preparing the financial statements, you need to post closing entries to clear out temporary accounts like revenues, expenses, and dividends. The closing entries involve debiting revenue accounts and crediting expense accounts. The remaining balance, in this case, $26,440, is transferred to retained earnings in the equity section of the balance sheet. This represents the profits being retained for future use. Looking at the post-closing trial balance, you will see that revenue and expense accounts have been reset to 0, preparing your books for the new year. These steps collectively form the accounting cycle, which involves identifying, recording, summarizing, and analyzing financial transactions, ultimately resulting in the preparation of financial statements. Thank you for tuning in to another episode of Kountin Koins. Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on the notifications. So I'll see you in the next episode of Kountin Koins. Happy accounting!